Canadian 5-year fixed mortgage rates skyrocketed this week as the Bank of England implemented a firm end date to its bond buying program. Now, hold on a second. Did I just say Bank of England? Yeah, I just said Bank of England. So the question you might ask is, why is the Bank of England playing a role in what's going on in Canadian mortgage rates? And it largely has to do with the effect that they are having on Canadian bond yields, which is what led to be what seemed to be some relief from rising interest rates, but then all of a sudden that got smacked down by the Bank of England refusing to continue their bond buying programs to save pension funds in the UK. But the interesting thing here is it seems that the banks in Canada tacked on just a little bit extra to mortgage rates. Whether that's to increase profitability or because they think interest rates are going to rise further, I'm not sure, but there's definitely two stories to tell here with respect to what's going on in the Canadian mortgage market. But before we get into the details, the cost of entry right now is hitting that subscribe button. So go ahead and do me that favor and click that right now. And just for fun, let's put your interest rate predictions in the comment section below. I want to know what you think is going to happen with fixed mortgage rates over the next year. Okay, so let's get into it. There's two stories here. The first is what the heck is happening in England and why that's affecting Canada. And the second is what is going on with Canadian mortgage rates as of right now. So let's start first and foremost with what happened with the Bank of England. So going back to 2 weeks ago, these were the headlines. Bank of England will buy UK bonds at whatever scale necessary to halt the crash. Now, what crash were they talking about? Well, they were talking about a potential crash of pension funds in the UK as a result of lower prices on bonds and what would have essentially been margin calls on those bond portfolios. Because what happens is that pension funds often buy bonds on leverage, and because the value of those bonds was going down so substantially due to rising interest rates, well, that put a lot of hedge funds in a position where they were going to get margin called. So the Bank of England stepped in and started buying bonds similar to what they did early in the pandemic in order to prop up the bond market. Now, fast forward to this week, and now the Bank of England is saying, listen, we are going to stop buying bonds as of Friday, because if we keep doing this, if we keep keeping interest rates low, we're just pushing our inflation problems down the road, and we are going to have a really big issue when it comes to fighting inflation and also keeping the British pound afloat compared to the US dollar. Think about this. A couple of years ago, it was basically 2 to 1. You could get 2 US dollars for every 1 British pound. Now the British pound and the US dollar are, for all intents and purposes, basically trading at even, which means the British pound has lost a significant amount of value. And this is because of that bond buying program and the fact that they were keeping interest rates low while the rest of the world, including the US and Canada, increased interest rates, which has a pretty negative effect on the value of their pound. Now, if you want to take a look at what happened in pretty much real time, here's bond yields as of today, 3.553%. And this is 2 weeks ago, right before the Bank of England started buying British bonds. Now, as a result, bond buyers started to look to other countries, and as a result, you saw the Canadian 5-year bond yield go down. This was because the prices for Canadian bonds were going up, which meant the yields went down, and we saw pretty much a 25 basis point crash overnight. Now, what was interesting was in this period, 2 or 3 days prior to September 27th, we saw interest rates go up substantially, and almost all the Canadian banks increased their 5-year mortgage rates as a result. So when these bond yields came down, we expected that mortgage rates would come down as well. And well, guess what? That didn't happen. So for the last 2 weeks, the spread between bond yields and 5-year fixed mortgages, which is how 5-year fixed mortgages are priced, has pretty much gone up. But we're still seeing the banks increase interest rates, even though they never honored the drop that we should have had over the last 2 weeks. So what the heck is going on here? Well, there's a couple potential things that could be happening. So first and foremost, the banks could just be saying, hey, we think that interest rates are going to continue to rise, the bond market yields are going to continue to rise, and we're just going to prepare for that right now. Second thing that could be happening is most of the banks are hitting their year ends, which means they could potentially be out of mortgage funds and they just don't want to participate until the beginning of their new fiscal years. And this is a common practice. Quite often in October and November, we start to see interest rates go up as some of the banks step out of the market, choose not to be as competitive because they are running out of available funds that they are allowed to lend. Now, that's not to say that they don't have the money to lend, but every bank in Canada has a limit on how much they are able to lend in mortgages. This is usually set by OSFI, and as they bump up against it, they tend to increase their prices and be less competitive so that they don't go over their lending limits. Now, the third thing that could be happening is the banks may just be saying, hey, we want to be more profitable, so we're not going to pass on these savings to the consumer. In fact, we're going to increase interest rates and increase margins to make up for the reduced number of transactions that's happening because of higher interest rates. So there's a number of things that could be happening here. It's hard to say which is which. My guess is as we head into the end of the year and into the new year, we're going to start seeing lenders and banks get more competitive again, and we're going to start seeing some lower rates relative to the bond yields. Now, I've talked a little bit here about the difference between bond yields and 5-year fixed rates and the spreads, and conceptually that might all be a little bit difficult to understand. So I want to show you the differences in the spreads going back to April versus where they are now, including one point in September where the spreads got back to normal and we thought mortgages were going back to being competitive. So here's how this works. You have the 5-year bond yield and you have a 5-year fixed rate. We're working off 5-year fixed mortgages here. And the difference between the bond yield and the rate is the spread, and that's essentially the margin for the lender. So the amount that they potentially can make. So in other words, the spread, the margin, is the difference between what they can put their money into safely and what they can lend it to you for. And typically banks like to see this run around 180 basis points or 1.8%. Now that's what they like to see it at. Since mortgage brokers became very prominent in 2002, 2003, the spread has typically run more closer to 120 to 130 basis points, so 1.2 to 1.3%. And this is the first year in my career where we've seen this spread jump quite significantly. Now, yes, it's fluctuated a little bit here and there. Sometimes it got up to 1.6, but very rarely did it get up to where we are today. So let me take you back to April 1st. April 1st of this year, and keep in mind, this is after the single biggest month of interest rate increases that we had ever seen, which was March, where interest rates went from pretty much under 2% to over 3% in 30 days. We were literally getting interest rate increases on a daily basis. Well, even at that time, even after that month of huge interest rate run-ups, the spread between the bond yield and the 5-year fixed rate was only 1.32%. So well within that sort of 130 basis points that we would expect. Then, as we moved into July, interest rates continued to increase. We saw the 5-year fixed rate go above 5% for the first time in a very, very, very long time. The bond yield at the time was 3.11%, which led to a spread of 1.93%. Now, this seemed like the banks were basically just stepping back and saying, okay, we think this is going to go up significantly more. It's getting a little bit expensive to hedge. And they started to build in some more profit margin. And we expected that this profit margin, the spread, would come down, and it did. As we moved into September, we saw all the lenders, all the banks get super competitive again. Interest rates dropped down to 4.59%. Even though the bond yields were up from July 1st, but that spread ended up being about 1.24%. So we were very much back to normal, at least normal compared to where it's been for the last 10 to 15 years. Then here's what happened October 1st. So those bond yields had actually come down since September 15th. We had just seen that spike that I previously showed you in bond yields. And because of that spike, interest rates had gone up to 4.84%. So our spread was now 1.511. Now, we expected that we would see interest rates drop. You saw that in my October interest rate update video where I said interest rates are probably going to come down a little bit. And lo and behold, the Bank of England, as I showed you, they put on the brakes and they said, whoa, we're going to stop buying bonds because we're just kicking the can way further down the road. And this is what ended up happening. Not only did bond yields go up, but interest rates went up substantially as well. So now we're back in that range of a 1.72% spread. So what does this all mean? Well, it means that the banks have significantly more margin in their mortgages today than they had 2 weeks ago. And they have even more margin in their mortgages today than they had a month ago. And what could happen is we could see those bond yields continue to increase, especially as the Bank of Canada is set to increase interest rates again, as is the Federal Reserve in the US. And we could see the banks take a pause from increasing interest rates to lower those spreads again and get a little bit more competitive. But more than likely, here's what's going to happen. We're going to have to wait until November before the banks decide to get competitive again. And then wherever bond markets take us is going to kind of dictate where the interest rates are going to be. And if the banks decide to get more competitive and they decide to get down to that 1.24% range, well, we could absolutely see lower interest rates in a month than we see right now. Of course, we could see higher interest rates in a month from now than we are seeing at the moment as well. But I think the point here is if you look back and you look at July, well, in July, we were seeing 5% interest rates, and then we were seeing a 0.5% lower in September. 3 months from now, who knows what the deal will be. But what we do know is this, is if we're watching the bond market yields, we can kind of predict what's going to happen with 5-year fixed mortgage rates. Now, that's not to say that just because you see the bond market come down or go up, you're going to be able to predict what happens with interest rates, but it's a pretty good indicator. But as of right now, the 5-year Canada government bond yield is the highest it's been since 2008, since pre-financial crisis. And so too is the 5-year fixed mortgage rate. So what that tells us is from a long-term perspective, we're still at interest rates that are still historically low. Nobody ever expected them to get down to 1.2 or 1.3%. But our interest rates are going back to what's considered a more normal environment. And as interest rate costs increase, demand should start to subside. And hopefully at some point in the near future here, we're going to be seeing lower interest rates once again. So that's what's happening in the Canadian mortgage market. Make sure that you continue to watch this channel for our mortgage interest rate updates. I'm going to put up an interest rate update video here in the next couple of days. And make sure that you subscribe and turn on the notification bells so that you can get those on a monthly basis. And if you've made it this far, there's a really good chance you are a potential home buyer. And if you're a home buyer, we have a home buyer masterclass that teaches you everything you need to know about buying a home and gives you a $1,000 credit if you end up choosing Mortgage 360 for your mortgage. So it's pretty much a no-brainer. So if you're looking at getting into the market, I highly suggest that you go ahead and sign up for that class. I've left 3 spots open for the first 3 people who get there, and I hope that we see you on the other side.